What up, guys? Welcome back to the channel. Mina the Money Goddess here, and I'm always sitting next to a houseplant, so perhaps I should call this Next to a Houseplant. Just like Zach Gallagher, he called his show Next to Two Ferns, In Between Two Ferns. That's right, In Between Two Ferns. Anyway, today we are going to talk about the psychology of investing. Do you have what it takes to be a successful investor? Let's find out. Let's go. All right, guys, today we're going to talk about 3 fallacies or 3 psychological indicators and why they are important when you are investing your money. The number 1 is the endowment effect. Number 2 is the status quo fallacy. And then finally 3, the anchor effect. So, all right, first up, let's talk a little bit about fear and greed. If you aren't familiar, Warren Buffett famously quoted, "Be fearful when others are greedy, and greedy when others are fearful." This statement is somewhat of a contrarian view on stock markets, and it relates directly to the price of an asset. So when some people are greedy, of course, the demand continue to increase, driving prices up, and people become very greedy. And that's where we get, what do we know? FOMO, which is fear of missing out. Conversely, when markets are going down in value, people tend to be very fearful. This is a stronger emotion for people about being afraid to lose money in this case, right? So people will take more action to avoid against a loss than to realize a gain. I'm going to say that one more time. People will take more action to avoid against a loss than to realize a gain. Okay, so we've established that the majority of human beings have a loss aversion, right? Who amongst us wants to lose money? None of us. Why else would we have the expression, "A bird in the hand is worth 2 in the bush"? So let's go over the endowment effect, which I think is very interesting in psychology and behavioral economics. The endowment effect is the finding that people are more likely to retain an object that they own than acquire the same object when they don't own it. So let's look at an illustration. Here is an illustration of the endowment effect, called the mug experiment. These fine professors here, which I will definitely butcher their names, conducted a study to see how the endowment effect influences our decision making. The scientists randomly divided participants into buyers and sellers and gave the sellers coffee mugs as a gift. Then they asked the sellers how much they would sell the mug for, and then they asked the buyers how much they would buy it for. And look what happened. The same coffee mug. Sellers thought it was significantly worth more than buyers thought that the coffee mug was worth, right? Everybody wants a bargain. Everybody wants to buy low and sell high. Here's the interesting thing. People appreciate things that they already own more than those which they might hold. The fear of losing the mug, loss aversion, becomes the cause of the contradiction in the evaluation of the cost of the coffee mug. So, trade with the trend, which we're going to go over. Market sentiment will give us the consensus of what something is worth. So keep this in mind about the endowment effect. Again, if you're holding something, sometimes you don't want to get rid of it and you think it's worth more than it really is. The next fallacy we are going to talk about is the status quo bias, which is an emotional bias for things to stay as they are. So a preference for the current state of affairs. That's pretty easy to understand, right? So you have a certain reference point. Most people are adverse to change, and so they would like things to stay as they are. If it ain't broke, why fix it, right? But the thing to keep in mind with investing is that everything changes, right? Especially in volatile markets. So especially regarding crypto in this altcoin season that we're seeing right now, do not get attached. We are going to go over some strategies in a minute, but the number one thing to do is smash that like button below and don't get attached. The final fallacy or cognitive bias we're going to talk about is called anchoring. The anchoring effect is a cognitive bias whereby an individual's decisions are influenced by a particular reference point or anchor. This is best shown regarding marketing. You've seen this all the time in marketing, so here we go. Here is an example of how anchoring is used in marketing, and we see this on a daily basis. So this is the original price is struck out. It was $60, and then now it is down to $34.99. It is perceived as a sale, but we all know if we are spending any money at all, we are not saving money. But if the comparison is $60 to $34.99, then clearly, yes, we intend to purchase this Columbia fleece jacket, and we would be saving 42%. How this relates to securities is maybe a story that you tell yourself. At one point in time, Amazon traded at $100 a share. Perhaps you thought it was a good buy at the time and you did not buy it. Now it's $3,000 a share. And so you don't buy it because you think, wow, I remember when it was $100. I should have bought it then. It's way overpriced. It's too expensive now. This is a cognitive bias. You are taking where you originally saw the price, and now that it is escalated and Amazon is now trading a much higher, you think it is not a good deal. You think it isn't a bargain anymore. And conversely, perhaps the same thing, you're waiting for the market to dip and you're waiting for a huge pullback, which may or may not come. And you're in the opportunity cost is you're missing out on return. So be aware that anchoring is a real true thing regarding price and what you think things are worth and the value. Again, it's all just a cognitive bias. We all know that all markets increase in value over time. So be aware of this and come up with a strategy so that this doesn't become, a hindrance for you. And don't allow emotions to dictate your actions. So I grabbed this from Secrets of Crypto Twitter feed. It's so good and so apropos. Dumb money trades on emotion. Who's been here? Altcoins suck. These are just scams. What? This altcoin is actually going up. What? I knew it. I'm the best. I'm literally taking over the world. As it moons. And then you keep buying along the way. And then you're like, wait a second. Did the developers quit? Was there a hack? How is this allowed to happen when things go down and you're selling as everything is down and you lose confidence? Well, smart money has a plan. Smart money has done fundamental research. They've read the white paper and the light paper. You've looked at the team. What utility does the coin have? Do you like the project? Can this be mass adopted? Does it help the world? Does it help things, right? So you got to look at things objectively, not only just the technical analysis. So let's come up with a plan so that you can chill while shit goes to the moon. All right, guys, let's talk strategy. There are three main strategies I'm going to go over. One is the buy and hold strategy. Everyone knows this. It's very easy to do. You buy low and you sell high. You dollar cost average every single month, $5, $10, $100, $500, whatever you can afford, and you automate your investments so that it's automatically investing into your index fund, target date fund, stocks, crypto, things that you really like and you are super bullish on and you're going to hold preferably forever. So sit back, put your feet up. This is the boring way to invest, but it is a tried and true method. What I would highly, highly recommend. The number 2 recommendation that I have, and this is mostly for crypto traders, is a moonbag strategy. So if your $1,000 initial investment becomes $5,000, bravo to you. However, don't be greedy. Take your $1,000 initial investment and take it off the table so that now you don't have any risk, as much risk, in the project, right? So your $1,000 has become $5,000. Fantastic. The $4,000 remaining is now your moon bag. So in that project, if it moons to $15,000, you win. However, which most crypto projects do, they crash and burn. They never get to the moon. And yeah, you end up losing money, right? So if you have taken out your initial investment, at least you've taken your money off the table. The third strategy to employ is smashing the subscribe and the like buttons below. It's actually called technical analysis, and if you are an option trader or a crypto trader or a forex trader, the thing to avoid is looking like my friend SpongeBob over here on the right. So we went over strategies 1 and 2, which will make you look like the guy on the left, but number 3 sometimes will leave you looking like the guy on the right. Up all night, red-eyed, very worried and nervous, especially because crypto markets trade 24/7. So here are a few things that you should know getting into this. First of all, you're going to have to learn. It's imperative that you learn how to read the charts, technical analysis. You've seen this before. These are candlesticks. You're going to learn Fibonacci retracements. You're going to learn support and resistance levels. You are also going to learn trading with the trend. You're going to become a surfer. You're going to ride the wave because markets go up and markets go down and markets go up and markets go down, and you're going to ride these waves and learn how to make money. Now, I have left a myriad of my favorite technical analysis videos below. YouTube is filled with them, and I have taken the guesswork out for you, and please check out all the links below. These are amazing videos that are very easy to follow, and you can at the very least learn some of the very basics, and it really will help you. So the other thing that I think that you should do is open a tradingview.com account and use a dummy account, a practice account, so that you are not putting all of your money into a market and you don't have a strategy. That's a big no-no. Please don't do that. So tradingview.com, you can open a play account, so to speak, and learn how to trade technical, how to use technical analysis, and how to use the charts to make money. So the last bit of advice is to use discipline, be consistent, and be patient. With these 3, you will become a successful investor. Also, your buy and hold strategy, your moonbag strategy, and the use of technical analysis, you will not go wrong. The final thing is to remember, when markets go up, employ your moonbag strategy. Don't have that endowment fallacy to where you get greedy and you think something is worth more than maybe it really is, or you're really wishing that it will rise to the moon and that you'll become a gajillionaire overnight. Please don't do this. Please take at least your money off the table, or at least understand if you are riding the trends, you're going to start seeing some patterns of reversal. So take action when necessary. Also employ limit orders, stop loss orders. Again, learn to trade with the trend. Use your support and resistance to help you. And if you don't want to do all of that stuff, just buy and hold things that you really like, and you do some analysis, you do some research. Who's the team? Does it have scalability? Does it have interoperability? Does it have utility? That's the number 1. Do these coins or projects have utility? Are they doing something that will help the planet? So do some research. You know, you can really put your money behind projects that you really love, and you will be less likely to panic, and you will less likely look like our friend SpongeBob right here, and you will also be less likely to sell when markets fall apart. And again, the best thing to know is how you react in certain kinds of markets. And that, my friends, is what will make you a super amazing investor.